Forex is a common term used to describe foreign exchange. It is also called currency trading or just FX trading. And every now and then you may see it referred to as spot FX. Why Forex? It is a market that is open 24/5. You can take longs or shorts, that you can trade at both ends of the market, either going up or going down. There's a range of different markets up to 80 pairs. It has unmatched liquidity. There's lots of money in the market, and then there is opportunity for leverage where you can use small capital, small margin to control larger margin or larger capital. Forex market opening time. For reference sake, every time I'll be using will strictly be the New York, pegged to the New York local time. So wherever you are in the world, you can always convert that. So the Forex market opening time. The Asia session, we have the Asia session, the London session, and the New York session. Although some people broke down the Asia session to the Sydney and the Tokyo session. But the Asian session is from 8 p.m. That's the Asian Open from 8 p.m. to 9:30 p.m. That's on Sunday. The market will open 8 p.m. to 9:30 p.m. EST. Then the London Open, that's from 3 a.m. to 5 a.m. So most of these times as a trader, you experience a lot of volatility, especially at 3 a.m. when the London opens, and then deep liquidity grab the market might gravitate or ascend towards a particular liquidity point. And then due to this volatility, there might just be slightly higher spread. And you might be seeing spread of 1-2 before, and then during the open you might see 5 points spread on the Euro USD, something like that. Then the London close. The London close is from 10 a.m. to 11:30, but the London fully closes 12 p.m. That's midday. So most times you can experience a lot of volume leading up to the London close. This is one of the biggest markets is closing down during a high volume because each of the sessions sometimes overlap. The London overlaps with the New York. So by the time London will close, the New York session will have been in play. So the London will be closing during the high volume New York session. So there's bound to be lots of movement in prices. For the New York Open now, that's from 8 a.m. to 9 a.m. This is the New York currency market open. Usually if the pre-New York, that's the time before the New York is ranging, we can see volume during this time. That's the New York Open. If prices are a range or a minor zone, it might most likely break during these high volume times. It's also now overlapping the London session. So there is high liquidity, high price moves during this time. And the New York Stock Exchange Open is from 9 a.m. to 10 a.m. Officially it's 9:30 a.m. That's if you check the NASDAQ session, the bulk of the move starts by 9:30 most of the time. Most 99%, except sometimes if there's a news at 8:30, you can check news out on Forex Factory. If there's the news at 8:30 for the dollar, then you see crazy moves then. But officially the New York Stock Exchange Open is at 9:30. So and equity is also open at this time. So moving on to the currency pairs. We have the major and the minor currency pairs. The major pairs are any currency that is paired or tagged to the dollar. So any currency pair tagged to the dollar, those are major currency pairs. And the minors are the non-dollar pairs, the non-US dollar pairs. That's it. So for the major currency pairs, they are the most heavily traded currency pairs in the world. So you have the Euro USD, the Japanese yen against the dollar, that's the USD/JPY, the Great Britain pounds against the dollar, US dollar, the Swiss franc, the US dollar against the Swiss franc, the US dollar against the Canadian dollar, the Australian dollar against the United States dollar, and then the New Zealand dollar against the United States dollar. So sometimes I might call the pound cable, the Great Britain pound cable. Those are just terms. Cable, the Swiss franc, I might call it Swissy, the Canadian dollar loonie, and the Australian dollar Aussie, and then the New Zealand dollar Kiwi. So those are just terms that are being used. And then for the minor pairs, popular cross, they are called crosses. So the popular ones are the euro against the Japanese yen, the cable against the Japanese yen, the cable against the Swiss franc, the euro against the Swiss franc, and a whole lot of others. The whole lot of others. Moving on to Forex quotes. Prices are quoted in terms of other currencies. This is because there is no measure of value. There is not another currency. However, the United States dollar is used as a base currency for determining the values of other currencies. So, in the picture you're seeing here, you're seeing the euro paired to the United States dollar, and then you see 1.2880/85. The 1.2880 is the bid. While the /85 is the ask. If they are to write that 85 out, it will be 1.2885. 1.2885. So sometimes you can check your chart and then see two prices. You might be saying 1.2880, and the other side you might be saying 1.2885. That 1.2880 is the bid price, while the 1.2885 is the ask price. That means if you are selling dollar immediately, the bid price is what you are selling it at. And if you are buying dollar immediately, the ask price is what you are selling it at, is what you are buying it at. So you can buy at 1.2885 and you can sell at 1.2880. So the difference between two of this is 5. So that 5 is 5 pips. That's why when you open your charts nowadays, you're going to see 5 numbers after the decimal point. 5 numbers after the decimal point. The last digit is the point. 10 points make a pip. 10 points make a pip. So if we have 1.28803, now the 3 is points. So when that 3 reaches to 10, instead of writing 10, it will go back to 0, and then you add 1 to the 4th number after the decimal point. So that's 1 pip increase. So that's about the bid and the ask. In order for you to start trading Forex, you have to open an online brokerage account to enable you to access the broker's trading platform. There are lots of brokers and most are willing to offer demo trading, so where you can practice it without actually risking real money. It's a little like playing Monopoly. Some offer $10,000, $100,000 demo accounts, where you practice with and you take trades to simulate real life capital. So, and this enables you to feel out each brokerage account is, the broker's account is, their trading platform, their spread, how others are fulfilled, how others are being filled in the marketplace. So after opening a brokerage account and you have tried their demo and you are comfortable and you want to move in to the step of depositing real money with a particular broker, which is not a financial advice. I'm not going to tell you to deposit money with any broker. I'm not advising you. I'm not choosing a broker for you to deposit with. Every of my videos are not financial advices. So the money you deposit with a broker, the money you have in your account that is available to trade with is your margin. And then some brokers now offer leverages. Some can go as high as 1 ratio 1,000. I've seen 1 ratio 3,000. There's 1 ratio 500. That's 500 ratio 1, 500 ratio 1, 200 ratio 1, 1,000 ratio 1, then 3,000 ratio 1. So what this means is, if you have $1, with $1, if a broker gives you 500 ratio 1, with $1, with every $1 in your account, you have the chance of controlling $500 with every $1. So therefore, if you have $10, that means you have a trading power of $5,000. So leverages enables you to amplify your gains, but at the same time, it can amplify your losses. So it's a two-edged sword. It goes both ways. You can amplify your gains and you can amplify your losses with leverage. Moving on to risk. I consider risk to be a very important issue when it comes to forex trading, because a lot of people don't really talk about it. They only take your eyes to the potential gains, the potential profit that you can have, what you can win. They all do that. But I'm not going to sell you pipe dreams. I'm not here to just promise you every strategy, everything you are going to be seeing in my channel is going to just be risk-free. No. What can go wrong? You can friggin' lose everything. You can friggin' lose all your margin. The margin can go to 0.00 before you know what's really happening. Other than you pick the wrong directions for the trade, which will happen every now and then. I'm not going to promise you 100% result, that you always be right 100%. No. You may also have internet problems, or an unfavorable news comes out. Human error. You didn't really check the news, you miscalculated the time, and then an unfavorable news comes out, and then before you know what's going on, you are down by 100, 50, 80 pips more than what you can cover. So you can really lose everything. You have to be careful. You have to take risk more than even thinking of profit. Risk is much more important than profit, because the major goal of trading forex is making money and surviving in this market. That's the major goal. It's not to flex at anybody that you're trading forex, you're a forex trader, you can speculate price, you know where the market will move. You might just be right, maybe 30 to 40% of the whole times you speculate at, but you might be profitable. But if you don't take risk as a very cogent thing, you might be right 90 to 95%, and then the 10 to 5% of which you aren't right, you get wiped out. So, pitfalls. One of the pitfalls is not using stops. Not using stops at all, where they be like, oh, this trade should just go here, there's no need for stop, it's so sure, it will never come down. You're not the one printing prices. You're not the one drawing those charts, drawing those lines or those candlesticks on the chart. So you must always put stops on all trades. You must use your stops on all trades. And then there's another thing, another pitfall people fall in is putting mental stops. Putting mental stops in the sense that they mentally note a particular point that, okay, if price gets here, I'm going to stop the trade. I'm going to close the trade up if price gets to this particular point. And it goes two ways, which both leads to doom. One of the ways is if you have a mental stop and you don't have the emotional fortitude to close it at that price point, you'll believe, oh, what if it turns and go in my favor? And then you keep reducing that stop, taking it down or taking it up more, and then you keep losing more till you get your claws cleaned or till you lose more than you're willing to lose. And also, another risk of putting mental stops is if you don't actually put the actual stop on the marketplace, the physical one, and then you just put it in your head that, okay, when price gets here and then an unfavorable news comes out, before you know it, you might just see your margin, hundreds of dollars margin or $1,000 margin getting wiped out, getting to 0.00. And as of that point, you start reloading your phone, your trading terminal, thinking, oh, is it the network? But you have gotten your claws cleaned. So always make sure you put stops on all trades. If you're going to lose, you lose. That's the cost of doing business. Every business experiences losses too. There are times when you experience losses, and that's the cost of doing business. You don't just do business and then when you have a loss, you fold up. You don't risk things that will make you fold up, go into liquidation. And another pitfall people fall into is risking more than you can afford to lose. This is a very wrong move. This is one of the dumbest moves to ever do. Why would you risk more than you can afford to lose? Because you risking more than you can afford to lose, we call these mental fractures. I call it mental fractures in the sense that you now be scared, placing other trades, thinking, oh, it's going to also fail. And then when you actually analyze the market and you actually get the market direction right, you'll be scared placing trades. So you'll be so afraid placing trades sometimes that even when you're supposed to go for it, you won't go for it. So risk is really, really cogent. Risk is really, really, really cogent. Left to me, I always advise risking nothing more than 2 to 3% per trade if you're, to me, a seasoned trader. Even if you're a beginner, I would advise highest 1%. The highest you should risk should be 1%. So let's say you have $1,000 and then you're risking 1% means you're risking $10. That is enough. You grow, you compound. If you keep making more, if you keep profiting, you get more confidence. And if you lose, you keep losing, you know, oh, I'm not risking something that will send me back home. And then you reevaluate, you sit down and think of, oh, what's making me lose? What am I doing wrong? What am I doing right? Reevaluating a trade is not only your winners that you should, it's not only your losses that you should reevaluate, you should also reevaluate the winners. What are the things I did right for this particular trade? How was my emotions in this particular trade? Because the most obvious thing that most traders is their emotions. You might have gotten, okay, this particular market should go to in this particular direction and should hit this liquidity target, and then you might just be like, oh, let me just take this small move, this small retracement move that should go down before going up here. And then in the process of trying to follow the retracement move, you get tripped out and then you lose. And then you now go against your bias, thinking, oh, I should make it. You keep imputing more and more trades, thinking when you just go back to my original position, my first position, then I close everything. But it doesn't work that way most times, and then you get your claws cleaned. that fucks up your emotion, fuck you up, and then you go to revenge trading that you must make everything back, and then you keep losing more. You keep entering that abyss where you keep losing more. So it's really, really important. Risk management is really, really important. It is really, really important because you are compounding profit. I'm not someone that will be teaching you, oh, you are flipping accounts. No. I prefer that slow growth, slow, steady growth where you survive in the market. It's not where I flip account and then I can blow everything in just one or two stupid trades. Yeah, you can make mistakes, you're human. You can get the market direction wrong, you can see things wrongly. And then imagine you have 99 good trades and then just one. 99 good trades, you have been making a hell of a lot of money, and then just one particular trade and then you get your whole clocks cleaned. That will create mental fractures where you'll be so afraid of getting into trading again. So when it comes to trading, most traders have a plan that they base their particular trading method on, be it the fundamental or the technical analysis, and to some extent I've heard of sentimental analysis. But I still believe this is just the two. So most retail traders base off of, on technical analysis. Technical analysis. But there are still some traders, there are traders that ignore the chart and trade based solely on fundamental analysis. And they trade off and around major news releases. So for let's say for an example, my I have thoughts, some long term thoughts on the Japanese economy where you can decide to buy or sell the yen against another currency. So maybe you're expecting a news release to that effect, whereby you are expecting the Japanese currency yen to just go up or go down, to be strong or to be weak against a particular currency, and then you buy or sell according to that idea. So, for example, let's also take another news, which is the non-farm employment change. That's the NFP, which is released 8:30 a.m. New York local time on the first Friday of every month. So, depending on this particular news can move price 100 pips, 80 pips in an heartbeat. Even if you go to the 1 second chart, the 1 second chart you might see just within 1 second this particular news is moving price 50, 60 pips. And if you're on the wrong side of that, you look out. You feel sick to your stomach. The CPI too. You can see it moving 60, 70 pips in one direction. So imagine you're trading based off of fundamental analysis, and then you place a trade before the news release. You place a trade before the news release, banking on betting on okay, the NFP delivering up for the dollar. So you're expecting foreign currencies to fall. And then you go to your bedroom and then the news get released. You're wrong. You didn't put any stop in place. Even sometimes when you put stops, by the time it will get triggered, you will lose a whole lot more if you're wrong. And then you come back only to see your margin cleaned out. You feel sick. But having said that, it can also go in your favor. But do you want to take that 50-50 risk? Because I've had traders, I've discussed with some traders and they tell me, oh, the market is just 50-50. Is either you buy or you sell. Not even the point of buying, where you have to buy, where you take your trades off, is more important than the 50-50. But the point here is, no matter what, be aware of the news. Be aware of the news. There are some that can trade successfully with fundamental analysis. But don't just jump right in because of, oh, there's potential of making you profit. Remember the risk lecture. What if you make a loss? There's also potential of making huge losses, and then you're now using leverages which will really amplify that loss. So the other type of analysis is the technical analysis, where most of the trading is done off the chart. So here you can hear people saying they are chartists, they are technical analysts. This is the way I trade. But the way I trade is still a bit more refined because I have to check. I also use a little bit of fundamental analysis. I also know when the news get released. I also have to check the time, check when each red folder news. You can check red or brown folder news. In Forex Factory, you can check their app. It's a very good place of checking any news on any currency whatsoever that's going to be released during the trading week. You can even go as to even map out the news that will be released throughout a whole month and have it in your notebook where you just check every day. So I do that, and then I base most of my trading off the charts, just using price action. I don't use any indicator, no Aikinachi, no Ichimoku, nothing. I don't use any indicator to trade. I base my trading solely off the chart and solely on price action. So that's the two ways of analyzing types of orders. We have the market order, the buy stop or sell stop, and the buy limit or the sell limit. For the market order, this is where we jump straight in and out of a trade at the current market price. This is where you're buying at the current bid or the ask price. Buying at the current ask price and you're selling at the current bid price. That is market order. So for the buy stop or sell stop, this is where you enter the market going with the trend. This is the easiest to explain. In the case of the buy stop order, you are placing an order above the current market price. You're placing an order above the current market price, and when the market price gets to it, when the market moves to it, your order gets filled. So for the buy stop, if you are projecting the market to rise, to go up more, then you are placing an order higher than the market price that when it goes there, the market should fill your order and then should continue to rise. And the opposite is for the sell stop. For the sell stop, you are setting an order below the current market price. And when the market falls, your order is filled on the way through and you're expecting it to fall more. That's the buy stop and the sell stop. For the buy limit or sell limit, now, this is where you're looking for a reversal and going against the current trend. For the buy limit or the sell limit, in the buy limit order, you are placing an order to buy below the current market price, looking for the market to drop down to your entry, get filled, and then hopefully the market to turn around and head up. That's for the buy limit. For the sell limit, this is the opposite of it. You are placing your order above the current market price and you're waiting for price to get up to your order, fill it, and then price should turn and gravitate down. That is the buy limit or the sell limit. I only use two types of orders out of this. I use the market order and the buy limit or the sell limit. I don't use the buy stop or the sell stop. I'm not a breakout artist. There are some that trade off that way, but I'm not. And I don't trade off that. Thank you. Until next time, have a lovely day. Please like and subscribe.